When wrapping up the Rentokil initial Q1 earnings call on April 16th, CFO Paul Edgecliffe-Johnson left investors with this comment. As I said when I started at Rentokil, that my ambition was to make Rentokil a nice, safe, boring stock, where we do what we said we're going to do. But when you look closely at the numbers and the questions Wall Street is asking, the story is anything but boring. Because the industry is growing, but is Rentokil keeping up? Welcome to Pest Control Unlocked. I'm your host, Konstantin Schwartz. For transparency, I am a former Rentokil employee, and this reflects my personal views and is not to be construed as investment advice. Today, we're diving into the newly released Q1 2026 trading update from Rentokil Initial and the subsequent call transcript with the financial analysts. This is a fascinating document covering the first 3 months of the year, and it carries a massive amount of weight. Why? Because this is our first real look at the company under its brand new chief executive, Mike Duffy. Furthermore, Wall Street has been keeping a microscope on Rentokil's North American operations. Leadership recently declared that the massive Terminix integration chapter is effectively behind them. And now the new focus is pure operational performance. But frankly, Wall Street seems skeptical. They aren't convinced the underlying organic engine can run on its own without M&A supporting the numbers. Despite hitting revenue targets, the stock actually dropped over 2.5% in pre-market trading right after the earnings statement was released. So let's break down the numbers and play back exactly what leadership had to say. More importantly, let's unlock what it means for operators on the ground. But as operators, we have to note a massive caveat right up front. This is a Q1 trading update and not a full earnings report. They are only showing us the top-line revenue. They are not showing us the margins or EBITDA. For the first quarter, Rentokil reported group revenue of $1.7 billion, with organic growth at 3.4%. Wall Street is busy modeling out that 3.4% growth in their projections. But operators should be asking a different question. What exactly did it cost them on the bottom line to get there, especially given today's wage pressures? In Q1, the North American business grew by 4.5% to $995 million in revenues. North American Pest Control Services delivered growth of 3.5%, including 6.1% from one-off job revenue and 3.0% from contract revenue, an improvement from the previous quarter's 2.4% contract revenue growth. Organic revenue growth was 2.8%. But how are they getting that 2.8%? On the call, CFO Paul Edgecliffe-Johnson was incredibly blunt about it. He told analysts, and I quote, "We're improving our pricing capabilities, and that's the driver of all the growth that we're seeing at the moment. Volumes are still in negative, in line with what we saw in the same half of last year." End quote. That is a massive admission. Historically, the structural pest control industry grows at about 4 to 5%. According to the latest data from specialty consultants, as published by PCT magazine, the pest control industry grew around 6% in 2025. Rentokil now comes in at 3.5% growth. The organic growth is 2.8%, just to put this into perspective. But they also explicitly admitted that their actual customer volume is shrinking. That means they are surviving entirely on pricing power right now. Edgecliffe-Johnson followed that up by stating their primary goal, and I quote, "The strategy for 2026 is to try to improve our volume performance, keep more customers, increase retention, and still hold on to that pricing." End quote. Basic business fundamentals, because pricing can stabilize a business, but it cannot drive long-term expansion and growth. Looking at retention, here's the metric every operator needs to hear. Rentokil reported that colleague retention actually increased to 82.6%, up 40 basis points, which is a massive operational win. However, in the current macroeconomic climate, improving retention by 40 basis points almost certainly came at a premium. To stop technicians from jumping ship, companies have to absorb increases in wages and operating costs. Rentokil is successfully protecting its workforce, but Wall Street knows that buying loyalty in a tight labor market directly compresses margins. On the other hand, customer retention remained flat at 80.4%, which seems neutral on the surface. But when you pair this flat retention rate with the CFO's explicit admission that customer volumes are still negative, it exposes a leaky bucket. They are successfully holding on to 8 out of 10 existing customers, but they are not acquiring enough new doors to replace the 20% that are leaving. The silver lining of that flat customer retention rate is that it proves Rentokil has incredible pricing power. They have pushed through robust price increases, and yet customers have not cancelled their services en masse. But this is a double-edged sword. Relying on price increases rather than volume to drive growth is a short-term lever. Eventually, you will hit a price ceiling where the next rate hike will trigger a sharp drop in that retention metric. When analyzing the economics of route density, retaining technicians is crucial because high turnover destroys route efficiency. However, if you have a highly retained and likely more expensive workforce servicing a shrinking volume of customers, the fundamental math of routing efficiencies begins to break down. You end up with stable technicians driving past empty doors, which ultimately degrades the profitability of the entire geographic cluster. Now, the business services segment of the North American business was a massive outlier in the data, and it had analysts asking questions. Business services posted a staggering 12.7% organic revenue growth. That was driven by pre-spring demand in product distribution, new brand standard wins, and big lake management contracts. But before you pivot your entire business model to mimic that, let's look at how leadership views it. When pressed by an analyst on whether this trend will continue, Cliff Johnson was quick to pour cold water on it. I do think that this is an aberration rather than the norm. I don't expect to see this level of growth from that business segment. I think it will revert back to a normal level of growth as we go through the year. Let's briefly look outside of North America. The international group brought in $682 million, up 4.1% with 2.8% organic growth. This was a mixed bag. They saw good growth across Europe and Latin America, driven by pricing and volume. But they faced a 60 basis point headwind from the Greater Pacific region and the Middle East North Africa region, partially due to the ongoing Middle East conflict. When asked if rising oil prices and supply chain issues through the Strait of Hormuz were threatening their margins, leadership dismissed the concern. The CFO noted, "We do spend a reasonable amount on fuel in the business, but it is only 2% of our cost base. We have got quite a few levers to pull there. The majority of our supplies are not coming through the Strait of Hormuz." So what is the grand takeaway from Rentokil's Q1 2026? It is a story of a company attempting to become exactly what their CFO wants: a nice, safe, boring stock. A new CEO took the reins, but the playbook hasn't changed. They are aggressively pushing price increases while actual sales volumes are declining. They are actively keeping their technicians in the trucks, boosting retention to 82.6%, which is ultimate key to route density. Wall Street analysts are going to model out the 3.4% organic growth. But for the operators listening to this, listen to the CFO's warning. Volume is negative. You cannot raise prices forever without eventually having to add net new doors to your routes. And one more thing worth noting. This is a trading update. We're only seeing revenue. We are not seeing margins. We're not seeing profitability in an environment with rising wages, pricing pressure, increasing operational investments required. The real question is not just how much they grew, but what it cost them to grow. That wraps up our analysis for Rentokil's Q1 trading update. Rollins and Ecolab will be up next. This is Pest Control Unlocked. My name is Konstantin Schwartz. Thank you for listening.